Good evening and welcome to the Money Show, your one-stop destination for everything that matters to your money. I'm Kavita Thapliyal. So whether you are saving, investing, borrowing or spending, we bring you the smartest conversations, expert insights and actionable advice to help you make the most of every rupee. Today, we decode the financial choices that affect your daily life, from insurance and taxes to mutual funds, credit scores and retirement planning, because in a world full of noises, you deserve clarity, and that's exactly what we deliver every single day. So whether you're a first-time investor or a seasoned planner or a young earner or someone eyeing financial freedom, the Money Show is here to help you take control of your money and your future. So let's get started. We'll flash our WhatsApp number and our email ID where you can send across your financial portfolio queries. Any strategy that you need for any financial goal, just send it across 865-797-4571. That's the WhatsApp number. The Money Show at etnow.tv is the email ID where you can send across your queries. And we also do your life financial planning on the show every day by our experts. Okay, let's move on. And we often talk about when to enter a mutual fund, which category to choose, and what kind of SIP to start, which fund manager to trust. But what we rarely discuss is this: when is it the right time to exit a mutual fund? Because just like entering a fund requires strategy, exiting a fund requires even more clarity and often more discipline. Is it poor performance, a change in fund manager, or has your personal goal already been met? Or maybe the market cycle demands a shift in asset allocation. Exiting too early can cut short your compounding. Exiting too late can erode your return. So today on the Money Show, we ask the big questions. What are the right reasons, the red flags, and the rational signs that tell you it's time to move out of a mutual fund? We'll decode it with the experts and help you make smarter, sharper decisions, not just about when to invest, but when to walk away as well. I have with me Dilshad Billimoria, founder and chief financial planner, Dilshad Consultants. Dilshad, hi. Good evening and welcome to the Money Show. Very important question: when to break up with a mutual fund? Okay, and I want to know what are the key indicators, that tell us that the fund is underperforming or, underperforming enough to take that exit call.
Hi, and thanks for having me on the show. I think there are a couple of indicators, when to exit, especially if consistency in underperformance is seen over a long period of time. We find that it may be a fund manager call that has gone wrong, and therefore we give the fund manager between 1 and 2 quarters to kind of rectify the underlying portfolio changes and make changes. If that does not happen, then we, give a red signal as an internal trigger, and we wait for another 1 or 2 months, and then we call it quits and ask clients to exit. So we are able to get, understanding across clients of a certain particular scheme. I think the other indicator is when a goal is close to its target date. It's important to move out of a scheme that is, on high on equity and move to something that is safer, like either arbitrage or liquid, to protect any downside or volatilities that might happen in the market in that period when the client actually needs the money. And most importantly, I think if the mandate of the fund is not being followed. For example, if a large cap fund has a mandate of investing obviously only in the top 100 stocks, and it actually moves into the next mid cap or small cap allocation, then this is against the SEBI categorization, and it does not meet the objective and the mandate of the fund, and therefore comparing apple to apple is a wrong comparison, and therefore we again raise a red flag, and if that continues, we then exit. I think another important consideration is if the market in a particular sector or a category is overvalued. At that point in time, we take a call and inform the
Right.
client that you probably need to
Sure.
exit or do a profit
But
booking
then
on that
usually how
particular
much time do
investment.
you give? How much time do you wait for, before concluding that it is an exit call? What happens is that kind of changes that you've also mentioned, sometimes they are also connected with market status and market volatility or market performance. So how much time should a fund holder actually wait? We should wait till it settles down, or we should give it
Yeah.
time for what, a quarter? What is the time period, for which we can wait?
Yeah. So, like I mentioned, I think it depends on the kind of changes that are made in the scheme. So, for example, if the continuously, we normally give 2 quarters, so that's 6 months. To a fund manager to kind of rectify if there are kind of mistakes made on certain calls or certain stocks that are being picked. If that still continues and there is underperformance, especially to the category average, we then say an exit.
Okay. Should a change in the fund manager investment strategy prompt an automatic review or an exit from the fund? Or you think even there is a new fund manager, maybe you've not heard about him earlier, and someone very new taking up as, in charge of the fund, you should give them the same time frame, around 6 to 8 months, for them to see what kind of changes are they introducing in the fund?
So typically, when it's a fund manager, it's actually a team of analysts which lead up to the fund management. So even though the fund manager is new or is changed in the recent past, typically calls are taken by the entire team of fund management and analysts before a final decision is made. So therefore, all parameters are checked, and it's not just dependency on one particular call or one investment call by the main person or the fund manager.
Now, what happens, Dilshad, is, these funds or these kind of investments are a lot of time attached to your financial goals, buying a house, retirement, kids' education, etc. How should you keep that in mind? How should you take a call of an exit when you have a fund aligned with these very important goals?
Yeah. So I think it's important to consider that if a goal is at least 6 months to 1 year away, at that point in time, we are suggesting that the client moves into a safer category, which is either arbitrage or liquid, to protect any downside or volatility that might happen between the current market and the actual realization of the goal. Because these are actually savings or investments that have been created over years for the client. So it's important that the corpus that is created is protected and needed, and is used when it is actually required. So kind of protect that into a safer investment, and then about 6 months to 1 year before, and then exit when the actual date of target goal is reached.
Now, if a financial goal is still 2 to 3 years away, okay, but the markets are peaking out, should one partially book profits or stay the course? What should one do?
Now, that's a good question. So, what we do is we have set internal triggers that if there are certain growth in the market, which is beyond a certain percentage, at that point in time, if it's especially 2 to 3 years away, we kind of book the profits and move that into a safer category. Unless the goal is 5 years away, we actually do tactical calls and we do profit booking in between to make sure that the client's requirement of that amount is actually met at the goal date.
Okay. Also, now let's talk about the asset allocation and rebalancing part, due to which you might want to exit a fund. Can you explain how portfolio rebalancing might require an investor to exit from certain funds, even if they are doing well? Should we do that?
Well, if a particular, I would say sector or a particular scheme or a particular strategy is not doing well in the market scenario, like an IPO fund or something like that, in that case, we definitely suggest an exit. And we kind of reallocate that as a tactical call, depending on the forward-looking volatility index, the markets in general, the overall macro, and the micro factors of the underlying portfolio as well.
Also, should asset allocation be reviewed annually, and how does one identify which funds to trim or exit during this particular process? What happens is, a lot of times, because we are doing a review, which you already highlighted earlier, that, things to be taken in mind, considered. But then, is annually reviewing your portfolio the right way to go about it? We should be doing it biannually, and, exiting a fund every 6 months is really not recommended, because if it's something that you've had in your portfolio, you should really give it time to perform, right?
Absolutely, and well said. I think importantly, clients must realize that there are costs associated with rebalancing. One of the costs are your taxation costs, obviously. So you have short-term capital gains on equity at 20% plus a charge before 1 year. And of course, you have your exit loads as well. So if I mean, advisor is able to have a clear cut strategy or a research mandate as to why, in the first place, a particular fund or a strategy has been recommended to a client, there really does not need to be a churning of more than say 1.5 2 years. I would not keep that 1 year kind of time frame as a kind of a fixed amount. I would say it would depend on certain changes like profit booking or underperformance or goal realization, or if the asset allocation mismatches happen. So those are the kind of instances when rebalancing is required in the portfolio.
Uh, any smarter way to stagger exits, to minimize the tax burden, especially if it's a high value redemption? Is there a way out of it?
Absolutely. So what we do is we try and spread that across 2 financial years, so that the taxation is spread, and the client gets the benefits of 1,25,000, 1,25,000 in 2 financial years as a kind of delayed strategy exit. And of course, that only will happen, one, like you said, if it's a large redemption, and two, if there is no hurry as such to exit that fund. If, for example, it's a very bad performing, or it doesn't follow the mandate, or it's underperforming, then of course the urgency is to try and exit and make up the loss of tax or the exit loads by reinvesting in better performing strategies.
Dilshad, one thing, investors, a lot of time they track the AUM of a fund, they track the NAV of a fund, and when suddenly there are changes in AUM and NAV, they really get tensed. And that's the time which triggers the exit also in a fund. Or there is consistent change in the portfolio also. Should an investor be concerned, and should that drive your exit call as well?
Well, as an advisor, we are monitoring the AUMs, but as an investor, I don't think that they should get very concerned unless there is a very big drop in the AUM. NAV is again, a misnomer or a myth where people think that, if a fund has a high NAV, it typically won't grow as well vis-a-vis a fund which has come out with an NFO. In fact, we do not suggest NFOs for various reasons. I think NAV changes should not be tracked on a daily basis or even a monthly basis. But looking at the AUM or the buy and sell calls of the underlying portfolio of a fund is where the advisor would take calls on, whether it's going as per the mandate, whether it's beating category averages, and it's meeting the requirement of the client needs.
Dilshad, let's also focus on the behavior and the emotional traps now, because we know that everyone is on social media. We take a lot of knowledge from everywhere, wherever we get. Now, what happens is during a market volatility, or during a particular trend or a phase that's going on, investors react emotionally. Okay, they take emotional decisions as far as the investments are concerned, like exiting too soon during volatility, because every kids during these time, what happens is they obviously look at the fund performance, and instead of just pumping in more money and maybe doing more of an SIP, they take an overall exit call. So what happens is, a lot of times you are in deeper losses, more than what the market has actually crashed or gone down at that particular time. So how can you avoid, and how can you play it smart? In fact, there is no need to maybe exit a fund. Definitely you have to see the performance, because what happens is, during this kind of a momentum that's going on in the market, if it's a bear phase, all of the peer funds would also be underperforming. Okay, so how does one take that exit call? Should one be exiting? Is comparing with the benchmark the right time, or overall just skip the idea of exiting the fund and don't be too emotional about it right now?
I think this is where the advisor alpha really comes into play, because when a fund is falling, it could be for various reasons, right? And it could be macro factors, it could be specific to the systematic risk of that particular fund. But I think it's important to cross check the actual reason of the underlying portfolio and securities in the fund before taking any harsh decisions. And this is where an advisor would be able to give that strategy as to why a particular fund is underperforming. And like you rightly said, if the same fund is performing, then underperforming, there might be others also which is underperforming, which does not mean that the underlying securities or the stocks that the fund manager holds in that portfolio are not good. It actually is because of the valuation, the price fall that is basically causing the fall in NAV, which is resulting in the overall returns being low. So it's important that the reason for that fall is evaluated very clearly before taking any hasty decisions. And in our kind of experience, we've seen that this happens a lot with do-it-yourself investors, when sometimes they have half-baked information, or they do not, or they just follow herd mentality, like you said, or they have FOMO, or they're seeing others doing something and therefore they're doing the same. This is where definitely an advisor would lend expertise.
How much is timing the market influence exit decision in your experience, if I just want to understand this? And is it ever advisable to do so? Because a lot of people, just want to time the market. I'm sure even, when there is a new client coming on board with you, you might have to do a lot of counseling also. I mean, financial advisors are part counselors. That's also, I feel, because you have to mentor them every aspect of the way they think about their money, right? So a lot of time investors have to time the market, which also influences their exit decision. Especially in a phase like recently, we do a lot of financial planning on the show. We do a lot of portfolio planning on the show as well. So we were seeing we were seeing a phase of, where people were having only mid cap and small caps in their portfolio. And once there was some negative return or a part of the portfolio was going down, they wanted to exit. So how would you like to explain this kind of a behavior, and what should one do?
Like you rightly said, I think the counseling part is very, very important, especially when a new prospect is getting onboarded. And, we have a very interesting chart which shows over the last 25 years how the markets have gone up and down, and how in the worst of scenarios, like, the 2008 crisis and 2013, etc., how the markets have actually rebounded, how long have they rebounded, and especially in situations like, say there is a budget situation. Sometimes clients say, oh, there's a budget, let's put everything in liquid. These are event based happenings, and therefore they will not last for more than about 15-20 days. So therefore, taking such aggressive, entry exit strategies, it's not right, and it's not good in the interest of the investor as well, because it costs money at the end of the day. I think the counseling, and to show that, okay, if the market has fallen, how fast has it rebounded? Or if a client says, no, let me wait for a further fall to happen. We've even got circumstances and instances where they are waiting for the fall, but after that, it is only kept rising. And that is where the opportunity cost has to be shown, of investing late vis-a-vis following the strategy that we had suggested. So we sometimes take calls of, either part lump sum, part STP, or, only SIP. That would depend again on basis of actual hard data that we are following. But to keep saying, let me wait on the sidelines without a clear idea of why you are doing something and just following the herd, I think that's the wrong way of doing it.
Right. All right. So fund exit strategy, and one should not be too emotional about it. But then, yeah, keep a track of your fund performance and take the exit call in the right way and due to right factors. Thank you so much, Dilshad, for being on the show and helping our viewers understand the right kind of exit strategy from a fund. Thank you.